And what's going on, guys, and welcome to the channel. In this video we are going to go over 5 tips that will make you a better day trader starting this week, and your portfolio, your P&L will thank you. So let's get right into it.
Drop it.
Now, tip number 1, you've probably heard it before, but you are going to hear it again. Journaling is the most important thing you can do as a beginner day trader. Now, we're not just talking about logs of your winners or your losers. We're talking about journals with detail as to why you took the trade, how you were feeling when you took the trade, what may have distracted you from the trade, how did the trade actually play out. I deal with thousands of individuals in our Discord community, and one of the things we tell them is to journal. Now, why do we ask them to journal? Because the journal acts as a receipt, and it's a receipt that I could then go through, kind of like a grocery list, and see everything you bought. But we then are able to find habits in the trading. And so what I would advise is you journal at the end of the week. You go ahead, away from the charts, away from everything, and you look at your journal. Now, this forces you as a trader to be honest with yourself. What was your emotional state in the trade? What was the news that prompted you to take the trade? Why did you lose the trade? Why did you win the trade? And you will see that there are habits, because every trader has a habit. You need to be able to identify your habits, especially if you find yourself losing more trades than winning trades. Being able to identify the habits via a journal allows you to quickly correct those mistakes. Stop holding and marrying your trades. Unless you're trading with a 10-year horizon, unless you have the expectation of buying Tesla now and holding till it makes you a billionaire, that's a completely different strategy and a different thesis. But the title of this video is Day Trader, which means that you want to be able to make money now. And of course, your thesis is much smaller, usually an intraday trade or maybe a swing trade overnight, okay? And in order to be successful as a day trader, you need to be able to cut your losses quickly. We do not hold, we do not marry our trades. This is not a relationship. You guys know relationships, oh my God, right? Sometimes we stay in relationships longer than we need to because we are in denial. And in fact, this is what happens to a lot of day traders who cannot admit that they're wrong, because there's almost a sense of guilt in being wrong. And feeling like you're wrong means you lost. And no one wants to feel like a loser. However, when you have a trading plan, you allow yourself for opportunities to present themselves trade after trade after trade. And the idea here is to trade long enough for your portfolio to grow, right? And the only way you could trade long enough is by preserving your capital. As I share with my Discord community, focus on, your goal is not to focus on winning. Your goal is to focus on not losing, because when you focus on not losing, then the opposite is true, right? And when we say focus on not losing, we mean don't lose big. 3, 4, 5% loss on a trade, that is absolutely fine. Stop chasing. Who cares what your buddy said about a particular ticker? Who cares what Twitter says? Who cares what Reddit says? Who cares what StockTook says? You need to be able to trade with control, because chasing is a day trader giving up control. You're essentially going with the herd, and you have absolutely no control of when that herd U-turns. And so let's get into the chart. I want to show you guys something here. This is UCAR. Now we're looking at UCAR on the 4-hour, and there are quite a few bag holders in UCAR. Now we're using our proprietary trading charts, which gives us indication of change of momentum here. We were able to identify the shift in momentum from UCAR, where you could see we had a low of 298. We got a call signal with a traffic light and a ginormous boom boom candle. And so we were able to be among the first in on the momentum shift, right? And this is what the market is about. It is first in, first out, right? Last in will usually be last out, and normally last in will usually be a bag holder. And let me give you an example of what last in looks like, because we can go over to June 2nd, I believe, and we could see immediately what last in looks like. So here we are in the chart, and okay, we had a nice run up to from 7 to 15. Now, what we're seeing here is it's already established a level pre-market, and it couldn't break this level. And so we get a retracement off of at market open. Obviously, you have to accept the volatilities, but then buyers begin to step in because they're like, this thing's gonna go higher, without understanding that there's actually a level. Or do they? You see, as you FOMO into this, and we actually had a member in our Discord FOMO into this trade, the guy who got in at $7, the guy who got in at $3 doesn't care if it breaks $15 or not. They have just seen a 500, 100% return depending on their entry, and that is good enough. A lot of beginner day traders go ahead and chase, and they have no context as to what they're chasing into. They're simply listening to their bros on YouTube, Twitter, StockTwits, and they're getting their asses handed to them. So I think this should be one of those things that you add to your rules. Do not chase. Attempt to be at the origin of the trade, or at the origin of momentum shift, which allows you to basically get the meat of the move on the trade and allow you to be the first in and the first out, not the last in and the last out. Because being the last out on this trade, especially buying in at the top, doesn't feel too good, does it? From 1529 all the way down to 875, you've lost nearly 50% of your trade, and as you could see, this just gets worse and worse and worse. Okay, so before jumping into any trade, ask yourself, are you having a FOMO experience? And just understand that nothing goes up forever, and what goes up must come down, and that is how you truly trade. It's actually the inverse of what you might think. When a stock has a major rally, I'm looking for a pullback. And I'll give you guys another example before we go on over to the next tip. But for instance, we have the SPY. Now, the SPY had a massive rally over the previous trading days. And what we have here are my trade designs, of which I introduced to the Discord community live. We were trading live, and as you can see, we established risk to rewards, but we are very much aware of support and resistance. So we designed this trade and ultimately knew exactly where this trade was going to go. Now, these indications here, I know they seem fancy and confusing, but these are essentially momentum indicators. We utilize the MACD with custom settings, RSI, again, custom settings, along with parabolic SAR. We also have an algorithmic AI, which triangulates and ultimately tries to guesstimate momentum changes. And so this is what we see here on the 200. Of course, we first get the algorithmic spider senses, and then we're given our traffic light here, as you guys could see, that yellow traffic light. And then, of course, we have our put signal on the trade, which guides us all the way down to the 200 EMA. And then we're also able to identify bounces on this trade as well, again, courtesy of we have confluence between the MACD, where the MACD is identifying a loss of bearish momentum, RSI breaking above its moving average and trending up, and with parabolic SAR also giving us agreement here. And of course, we have our assistant, Invictus, very, very powerful algorithmic artificial intelligence, which then clues us in on another shift of momentum. And then we can get confluence with also another traffic light and then a call signal, and then we hit another level. All this is done automatically on our charts, and this really takes a lot of the guesswork out of the trade. But most importantly, what I like to believe is that the system keeps you from chasing, keeps you out of FOMO territory, and keeps you humble and guided and realistic in your trade. And this is something that you lose sight of the minute you allow your emotions to compel you to enter the trade and begin to FOMO and think that the stock is going to go to the moon. Let's talk about a scenario here. You have $1,000. You see your buddies on social media just pumping a stock, right? It's up 30%. You got $1,000. You YOLO into it, right? And then from your point of entry, the stock goes down 10%, 20%, 30%. You have now deleveraged yourself, literally destroyed your portfolio. You have absolutely no leverage in your trade because you FOMO'd, you had no trading plan, right? And you married into the trade, right? And that is why I sort of cringe on, the YOLO guys at Wall Street Bets. I cringe on some of the comments on Webull, StockTwits, Twitter. I just absolutely cringe. Now, the rule of thumb is to allocate at the most 10%, but usually probably want to go with a 5% entry of your portfolio. Now, let me explain. If you have $1,000 and you want to go ahead and buy stock XYZ trading at $25, right? If you wanted a 10% allocation, you would buy 4 shares for $100. If you wanted a 5% allocation, you would buy 2 shares for $50. If you wanted a 2.5% allocation, you will buy 1 share for $25, right? Now, why do we do that? We do that because there's something that I believe in. I believe in the power of compound interest. Some people call it the 8th wonder of the world, but I'm going to go ahead and show you this calculator here. We have a starting amount of $1,000. And if you allowed your portfolio to earn on average of 1% a day, you will achieve financial freedom within 695 trading days, which is at or about 3 years. That is amazing. Now, we also have this earnings breakdown, and my oh my, $1,000 portfolio, all I would have to do is earn $10. Now, let me break this down. This is really, really fun. So let's say you had a 10% allocation from your $1,000 port. So you're risking $100, right? And so you got $100 in there. You need the share value to go from $25 to $27.50, and you've made your $10 for the day, and you've only risked 10% of your port, right? If you enter with a 5% allocation, you would need it to go $5, but that is a 5% allocation, right? Now, if you went ahead and entered with a 2.5% allocation, you would need it to go $10 to earn your $10 because you're buying 1 share, right? Simple mathematics. But the thing is that to achieve your goal of financial freedom of 1% compounded a day, you don't have to expose your entire portfolio to any one particular trade. You have time on your side, allow the magic of compound interest work in your favor. This is also considered the sliding scale of risk. And so when we trade options, advanced traders, we tend to go ahead and, especially for swings, we size for zero, meaning we take something like 1% of our portfolio and we buy an expiration 1 to 2 months out, right? And we just let it rock and roll. We let it do its thing. We're already sized for zero. We know we've only risked 1% of our port on that trade. But risk management is absolutely mission critical to your success. Now, here's the flip side to that. If you enter with a 5% allocation, you allow yourself to be wrong up to 20% before you vacate your position. That 20% with a 5% allocation will only ding your port by 1% in total. And this is the beauty of trading small to win big. And it's wild to me where we find a lot of traders who play big to win big, but it's actually more impressive when you trade small to win big, right? And this brings up another thing. A lot of beginner traders tend to trade with dollar amounts in mind when you should truly be trading with percentages in mind. And I don't really care what's going on with social media. Someone says I made, X amount of dollars. In fact, I was told, hey, Gabe, show your portfolio in the community. And I was a little embarrassed because my year to date was a little over $2.2 million year to date. But I feel like showing it in percentages makes it inclusive and sort of kind of drives the point home that slow and steady wins that race. It took me decades to build my portfolio to where it's at, okay? But when you're trading in percentages, you will find that your trading may or may not be on par to my trading, and that is the ultimate metric to be able to identify if you're a good trader or not, and that is percentages, not dollar amounts. So stop trading in dollar amounts and you will definitely set your portfolio free, and you will be more conscious of your portfolio growth. And those percentages, as we highlight here, simply stack up. Nowhere on earth are you able to find something that could potentially give you a 100,000+% return. But you know what? It happens. And it happens for traders who are patient, right? Who journal, who understand risk management, who avoid the FOMO, who avoid the chasing, who have mastered their charts, understand momentum, and they've made that conscious decision to do it now. This is Gabe. I'm signing out. Peace.